Good morning, everyone. Uh, so we have come to the last topic of our course module for this time, this semester. So the last topic that we are to cover is the financial ratios. So as you know, now we have been going through almost 20 weeks of lessons, and this is the last chapter we are supposed to cover. And by this time, I believe that all of you all have covered or revised all what you have done so far, and you have a fair knowledge about all what we have learned so far, especially with regard to the double entries, journals, and what is a trial balance, how to extract a trial balance, and based on the trial balance, how you prepare the different types of financial statements. And up to that, we have come through. So last week we looked at the statement of cash flows. So that completes the full set of financial statements as far as your examination requirement is concerned. So today we are going to look at a topic which is on chapter 17, which is the financial ratios. But as of to date, this has not been tested as a separate area. So maybe you might get here and there one or two sub questions. But as of now, it has not been tested as a full separate question. So you might get something to do with in MCQs or maybe a part of in the essay type question. However, we have to go through this chapter. So let's start looking at the financial ratios. So first of all, what is a ratio? As you know, a ratio is the relationship between two variables presented in a statistical nature. So we are trying to learn or understand relationships between two variables. When I say two variables, it could be considered as two factors. Two factors. Now, you might have learned in your maybe say primary education or maybe in your advanced level education what you mean by two variables. We always talk about, when we say two variables, x and y. So x and y could be two variables. But what we are trying to understand here is, by meaning of ratio, is the relationship between these two variables. So you are trying to build up a relationship between x and y. So this x and y will give you a representation of, or a meaningful representation of what we are trying to understand. So these ratios can be related to any line of study. So it is not only financial reporting, but you can have ratios relating to any subject area. But what we are going to look at is how these ratios, the concept of ratios, is going to have a meaning in the financial accounting aspect. So analysis of accounting ratios will be done based on the information furnished in the financial statements. So people, when they evaluate financial statements, especially in the case of credit officers or those who are evaluating customers' loan requests, so you might have to also go through their financial statements. Now, these financial statements will give you various aspects. For example, you will have what is the stock level, what is the debtors, how much of cash they have. So various components are there. But in order to understand a financial statement better, what people do is they calculate various type of ratios. And these ratios have standard benchmarks. So the performance of the customer or the business is evaluated against some of these benchmarks of ratios. So you will calculate ratios for this specific business or for this particular individual based on their business performance, and then you compare that against industry performances or maybe peer performances, that is the businesses whichever in the same field, or maybe from an analytical point of view. There are certain analysts who might work out these ratios. But in order to do all these ratios, you need the financial statements. So based on the financial statements only, we will prepare any kind of ratio that we are going to learn now onwards. So ratios could be presented either as a percentage. So you might have seen figures are presented like 5%. 5% means there is a meaning. Now, right now, if we say 5% or 10%, it relates to a interest rate. Interest rates normally go as a percentage. But there are instances where ratios are calculated as times, number of times. This is this amount of times of this. So again, we are talking about a relationship between two variables, but the presentation of that ratio will be in terms of times, or it could be a ratio which is equal to 1. Okay, so that is how these ratios are presented when it comes to financial analysis. So the types of ratios that are commonly known as liquidity, profitability, gearing, investment, and turnover. So the liquidity ratios, which talks about the cash position or the liquid asset position of a company or a business. Profitability means basically it's your performance. Gearing means the level of borrowing that you have. Investment is somebody who have invested in your share or in your company, what would be the return that you are going to give them. And finally, turnover ratios, that is operational ratios. On a day-to-day business per se, whatever the performances that you reflect in your day-to-day operations, and that will be converted into a meaningful ratio for people to understand. So liquidity ratios is referred as the financial ability of the business to meet its short-term liabilities. So what do you mean by liquidity is the ability of a business to meet its short-term liabilities. So you know now we have learned current assets, current liabilities. So short-term liabilities means basically the current liabilities that you have in your business. So if somebody is capable of meeting their current liabilities or the short-term liabilities, whatever that needs to be paid, you can assume that they are good in liquidity. That particular business is sound with liquidity. So the key liquidity ratios are current ratio and the quick asset ratio. So current ratio is a ratio that is calculated to understand the relationship between two variables. Now, what are the two variables? The two variables will be current assets and current liabilities. So current ratio will give you a relationship between current assets and current liabilities, whereas the quick asset ratio or the acid test ratio is again the relationship between current asset and current liability, but after discounting the value of stock that you have in your business. So let me put it in a formula to understand better. This is how the current ratio and the quick asset ratio will look at. So the current ratio is current assets divided by current liabilities. Then what you get is an answer which is normally in the number of times. So current assets divided by current liability mean normally we talk in terms of times, or you can talk in terms of a ratio which is this much is to this much. So generally these two ratios are calculated in terms of current assets and current liabilities, but presented either in the form of a number of times or in the form of a ratio. So what is quick asset ratio is the quick asset ratio is the current assets minus where you deduct your stock position. You deduct your stock position. So let me illustrate this on the board for you to easily understand. So if we look at a business concern where, let's say, from your asset position, you have current assets of, let's say, 30 million and long-term assets or the non-current assets, you have 20 million, so that you have 50 million here. Then you have current liabilities, which is about 15 million. Non-current liabilities, which is, let's say, about 5 million. And you have capital, which is about 30 million. Again, you have a balance sheet of 50 million. Now, what we are trying to understand here is the relationship between two variables, namely, current assets and current liabilities. So the relationship that we are trying to establish here is between the current assets and current liabilities. So if you look at the ratio, we say current ratio is where you divide the current assets by the current liability. So look at this business. In this business, current assets is 30 million, current liability is 15 million. So you get an answer 30 divided by 15, which is 2. So the same 2 can be represented in another manner. That is, current asset is to current liabilities. So which means 30 each to 15. So you divide by the lower number, which is 15, then you get 2 is to 1. 2 is to 1. Similarly, we do the quick asset ratio. Quick asset ratio. So let's assume that within this current assets, you have 15 million of stock. 15 million of stock. So your quick asset ratio will be current assets minus stock divided by current liabilities. Current assets minus stock divided by current liabilities. So current assets is 30 million. Within that you have a stock of 15 million and then current liabilities 15 million. So which will give you an answer of 15 divided by 15, which is 1. Or in other words, the quick asset ratio is equivalent to 1 is to. So this is what we are trying to establish. When it comes to the ratios, the current ratio is a representation of the current assets divided by the current liabilities, and the quick asset ratio is where the current assets minus stocks divided by the current liabilities. Current assets minus stock divided by the current liabilities. So that will give you the quick asset ratio. Now, when it comes to these two ratios, we have to be very knowledgeable about how do we compare and contrast these ratios, or how do we interpret these ratios. How do we interpret these ratios? So interpreting this ratio is very important. Interpretation of a ratio is very important. So when it comes to the liquidity ratio, especially the current asset ratio, I said it will be compared against a benchmark. It will be compared against a benchmark. So for normal businesses, which this current ratio is not applicable for banks, because bank doesn't have this concept of current assets. But other trading businesses, you will have these current assets, current liabilities, non-current assets, and so therefore you can calculate those ratios. And when it comes to the current ratio, it is very important that how do you measure this performance, or how do you evaluate this particular ratio. So when it comes to the current ratio, the general benchmark for a current ratio will be 2:1. 2:1. So if you are getting any other ratio beyond this number, means that is how you have to interpret. That is how you have to interpret. So for example, if you are getting a current asset ratio of 4:1 means, yes, that company is very good. Why? For every current asset, with every one current liability, you have 4 current assets to settle. So that is very good. But the problem is what? When you have current assets too much, means you are not going to earn anything. You are not going to earn anything. What do you mean by current assets? Your cash, short-term investments, likewise. So having a higher ratio doesn't mean that you are very good. No. The understanding should be the ideal ratio should be 2:1 for a trading business. But having more doesn't mean it is bad, but it is not useful because you are not earning a better profit. So here is the dilemma that we are talking about against liquidity versus profitability. Liquidity versus profitability. So most of the time what happens, businesses may have to compromise on liquidity to earn a better profitability. Or in other words, sometimes if you try to maintain liquidity, you might lose on profitability. So to have an optimum level of liquidity and profitability, maintaining a ratio of 2:1 would be very ideal. 2:1 would be very ideal. Now we look at the other side of the story, that is the quick asset ratio. Now similar to this current asset ratio of 2:1, the general norm of quick asset ratio is 1:1. So I took this example just to be in line with these two norms, but in real world you might not get this as 2:1 and 1:1. You might have different answers. So in the examination, suppose if you are supposed to calculate these ratios and interpret those, you have to mention about this. The benchmark for current ratio will be 2:1, but the ratio that you would have calculated may be 4:1 or something different. Then you have to say this, that the company is maintaining a higher liquid current asset ratio, but it may not be good enough to earn a better profit. Okay. Now, alternatively, what happens if this ratio is something like this? 0.5:1. 0.5:1. So always remember, the first one is a current asset, the next one is current liability. So in order to settle every 1 rupee of current liability, you have only 50 cents. You have only 50 cents. So that is very risky. If you don't have money to settle your current liabilities, means your business is at a liquidity risk. So businesses have to be managed in a correct manner so that you maintain your optimum liquidity to earn a better profitability. So the liquidity going down below, maybe say even below 1:1 is not good for the business, which means they are entering into a crisis situation. Okay, so please remember that the general norms for the current ratio and the quick asset ratio will be 2:1 and 1:1. Okay, going back to our slides. So this is what liquidity ratios are, current ratio and quick asset ratio. Then we look at the profitability ratio. So profitability ratio is basically to look at how your profitability is effective, how much your profitability is effective. So here we discuss about 4 types of ratios. Primarily, two of the ratios are relating to your trading business, directly relating to your trading business. And the remaining two are from the perspective of an investment. From the perspective of an investment. So what are the four ratios we are talking about? First one is the gross profit ratio or the gross profit margin. Second one is the net profit ratio or the net profit margin. Third one is the return on capital employed. And the fourth one is the return on equity. So remember, all these ratios are going to deal with two variables. So what you need to know is what are these two variables and how do I extract those two variables from the financial statements. Let's look at the gross profit ratio. So how does the gross profit ratio is calculated? Yes, you know how to calculate the gross profit now. So you take the gross profit from the financial statement and divide that by the sales. So when you are trying to calculate the gross profit, you would have considered a sales amount, and you have to take that sales amount and divide that amount from the gross profit. And what is important here is the gross profit ratio is represented by way of a percentage. So that is why we multiply by 100%. 100%. So the two variables involved here is the gross profit and the sales, and you calculate the relationship and you multiply that by 100%. So what do you get here? The gross profit as a percentage of your sales. If you are making 100 rupees of sales, of that sales, what is your gross profit? So let's say you have a gross profit of 30 from 100 rupees of sales. Then what do you mean by that? Your gross profit ratio is 30%. So if somebody tell you my gross profit ratio is 45%, what do you mean by that? For every 100 rupee of sales, I make 45 rupees as a gross profit. The next ratio is the net profit ratio. So that is again very straightforward. You divide the net profit by again the sales amount. So in both the cases, whether it is gross profit or net profit, you are comparing the relationship with the total sales that you have done. So here the sales is cash as well as credit. It includes cash sales as well as credit sales. Now the next set of ratio is slightly different. There we say return on capital employed and return on equity. Let me first take return on equity. So return on equity is very straightforward again, where you divide the net profit by the total equity. You divide the net profit by the total equity. So what do you mean by net profit? You know that is the ultimate result of your P&L, and total equity is the total capital and reserves that you have in your business. Okay. Then when it comes to the return on capital employed, here again, you have an important term that is described here, which is known as the earnings before interest and tax. Earnings before interest and tax. So we normally call this as EBIT. EBIT has a meaning. EBIT has a meaning. So we need to know what is this EBIT is and how do we calculate it. How do we calculate it? So EBIT is, that is in other words, return on capital employed. Return on capital employed is EBIT divided by capital employed into 100%. Into 100%. Okay, into 100%. Right. So let me again explain it on the board because it's very important. Right. So now this is what return on capital employed is. Return on capital employed is EBIT, earnings before interest and tax, and then you have capital employed. So capital employed is very straightforward from your financial statement, where you take the total assets and you deduct the current liabilities. Total assets divided by the current liabilities. But the earnings before interest and tax is little bit confusing. Earnings before interest and tax is little confusing. So how do we calculate the earnings before interest and tax? Now, if you take a financial statement, where I will go by the same thing, gross profit, right? Then you will have overheads. We have done this in the class. Then you come to profit before tax. Then you have tax and profit after tax. Profit after tax. So this is how your financial statement will look like. Now we are talking about a figure here which is known as earnings before interest and tax. So what do you mean by earnings before interest and tax is, from your P&L or the profitability statement, you have to take the profit before deducting the interest and tax. So this I and T means I is interest, T is tax. Okay, I is interest and T is tax. So within this financial statement, if you have paid any interest to the bank for the overdraft that you have taken or for the loans that you have taken, that interest amount and this tax amount has to be removed from your profitability. Removed from your profitability. So what we do is, we normally take the profit after tax. We call it as PAT. Profit after tax, because that is the easily known number. Now what do? We have to take before interest and tax means this is after deducting interest and tax. So what do? We take the PAT and we go and add the tax and the interest. So in examination, mostly it will be like this, where you will have to calculate the EBIT using the financial information provided. Using the financial information provided. So the information that is provided to you will be basically, you will have the profit, which is after tax, and then you might have this information, which is known as the tax and the interest that you will add to the profit after tax. Profit after tax. Okay, so that is how you calculate the EBIT for this purpose. So the earnings before tax is, as I explained to you, you take the profit after tax and you add the interest and tax to that. But capital employed is total assets minus current liabilities. And return on equity is net profit divided by total equity. Net profit divided by total equity. Then we come to the gearing ratios. Gearing ratios relationship between the equity capital and the loan capital. Loan capital means how much you have borrowed. How much you have borrowed. So here also we have two important ratios. I will straight away go to the ratio template, where we call an important ratio, which is the debt equity ratio. So the debt equity ratio gives you a relationship between your debts and the total equity. So what do you mean by debt? A company which might have borrowed from the bank in the form of a loan, maybe overdraft, whatever it could be, that is called your debt. The total equity means your capital and reserves. Now, what do you mean by this debt equity ratio is you are trying to build up a relationship between the borrowings that you have in your business and the equity. Now, equity, you need not be paying back. Shareholders will give you capital and you don't need to pay back them. But debts are not like that. Debts have to be paid back. The person who has given the loan needs to be paid back. So as a result, this is a very risky area for a business. That is why we call this as a gearing ratio. Now, when the gear goes up, what happens? You might enter into accidents. Okay. But if the gearing is very low also, what will happen? Your vehicle may not move. So you have to balance your gearing in order to have a better driving speed. So likewise, in the businesses also, the gearing cannot be very high and the gearing cannot be too low also. So what you need to is maintain it an average level. Maybe say 30%, 40% is a good indicator, but not maybe say 5%, 2% like it is not worth. And going to 60, 70% or maybe beyond that is a very risky venture. So how do we calculate the gearing ratio is debts divided by total equity. Debts divided by total equity. Then relating to the same, when you borrow money, what will happen? You have to pay interest. You have to pay interest. So this interest, whether how much you are capable in paying this interest, how much capable you are in repaying the interest. That is what interest cover ratio is. Interest cover ratio. So in order to calculate the interest cover ratio, again, we are using the same item, which is called the EBIT. EBIT is the earnings before interest and tax. So you take the earnings before interest and tax and you divide that by the interest expense that you have incurred. So maybe for the loan, you would have paid some interest that you have to use to divide the EBIT. So we have also got some investor ratios. These what you have see here is the definitions. So you need to be able to write these in terms of short notes if you are required to write it in exam. But let's look at the formula per se. Now earnings per share. Earnings per share. Now you have a business in which shareholders have put money. So they have bought shares from you. And in return, what do you give? You give them the dividend. But for somebody to come and invest in your business, they need to know how much of earning that you make per share invested by them. So that is known as earnings per share. So earnings per share is calculated using the profit after tax. You divide that by the number of weighted average shares. And here also we take the ordinary shares. So you have to be very careful. Profit after tax divided by the shares, number of shares. So when you divide profit by another number of shares, you will get an amount which is very small normally. Because even though profit will be very high in billions or millions, but when you divide by this number of shares, which is also huge, then you will end up getting maybe in a small amount of rupees, say maybe 5-10 rupees or maybe say 20-30 rupees, depending on the performance of the company. Now, as I told you, there is another indicator which is known as the earnings yield. So if you have a share and if this particular share is listed in the stock market, then what will happen? These shares will get traded and that traded share will have a price. So we calculate a ratio called earnings yield. Again, it will be a percentage. And how do we calculate this? That is earnings per share. So earnings per share is the ratio that you calculated at the top. And that ratio or the earnings that you get for share is divided by the market price per share. So let's say your earnings per share is 15 rupees and your market price per share is 75 rupees. So what is your earnings yield? Earnings yield will be 20%. Earnings yield will be 20%. So what it mean for the price that you pay in the market, what is the value that you will get from the business? Okay. So if you are having a share which is trading at 75 rupees, in terms of the business, it is only 15 or 20% return that you are going to get. So when you calculate the same ratio upside down or the inversion of that particular ratio, that is known as price earning ratio. That is market price per share divided by EPS. Earlier, you saw earnings per share divided by the market price. But there we multiplied it by 100, so that became a percentage. But here, price earnings ratio is again a ratio which is reflected in terms of times. In terms of times. Then for every investment, I told you that you will pay a dividend. You will pay a dividend. So what is the dividend that you have paid? And will it be worthwhile for the investor? Those are the questions that will come from an investor's point of view. That is why we call these ratios as investor ratios. So the first ratio that you calculate is dividend per share. Dividend per share. So you will have paid a dividend and you divide that by the number of weighted average ordinary shares. It is the same as what we used earlier for the EPS. And what we are calculating here, sorry, there is a small mistake here. This should be DPS. So your dividend per share will be ordinary share dividend divided by the number of shares. Again, you will get something in terms of rupees. In terms of rupees. So nowadays, if you look at the companies, they pay 2 rupees, 3 rupees, maybe maximum they go up to 7 or 8 rupees. So the dividend that is paid per share today is somewhat in that range. Then you will also have ratios which are called dividend yield, dividend cover. These are all interpretations of your previously calculated ratios. So dividend yield is dividend per share divided by market price per share. Dividend cover ratio is profit after tax divided by dividends for ordinary shares. So what happens is in exams, I don't know whether all the ratios will be tested, but it will be better for you to know them and go to the examination. Okay. So you might have to memorize these, or either you have to work out several times and then only you will get to know what these ratios are. And the last ratio and the investor ratio is the dividend payout ratio. So this measures the capacity of the company or the level of the company to pay out dividends to its shareholders. So how do you compare? It has to be based on your profitability. So now here you have already calculated dividend per share and you divide that by the earnings per share. Now, for example, in the exam, if you are asked to calculate the dividend payout ratio, you know that you can't directly calculate it. What you need to do? First, you have to go and calculate the dividend per share. Right? That is this. And then you have to calculate the EPS, earnings per share. That is this. So then only you can calculate the dividend payout ratio, because it is dividend per share divided by EPS into 100%. Okay. And the last set of ratio is the turnover ratios, where as I told you, these are all operational related ratios. That is how much of debtors you have, how much of stocks you have, how much of creditors you have. So all are relating to that type of ratios. So here we have about 5 sets of ratios, if I'm not mistaken. Yes. So the first one is something related to the debtors of your business. Debtors of your business. I think I spoke to you all this regarding this when we did the operating cycle. Okay, you can go back and refer to your notes. When we did the operating cycle, I explained to you the debtor turnover ratio or the debtor turnover period. So how many days that you take to collect money from your debtors? So how do you calculate it? Average debtors divided by credit sales into 365 days. Now, why you divide it by credit sales only means you are looking at debtors. How will your debtors come? That is through the credit sales. Because when you do a cash sale, there is no debtor. It is straight away debit cash, credit sales. But when you have a credit sale, what happens? You will debit the debtors and it goes to the sales. So what we are trying to understand here is when you have done a credit sale to one of your debtors, how long do you take to collect money from that particular debtor? That is what debtor collection period is. Similarly, you can calculate stock turnover ratio. We call it as stock turnover ratio. Now, what is this? Can you remember I explained to you? How long do you take your stock to be sold, into a finished good? Or in other words, you make it a credit sale. So from the warehouse, using the raw materials, you might have prepared or manufactured the good. Your good comes to the showroom and it stays there as a stock. Now from that date, how long do you take this particular stock to be sold to a customer? That is called stock turnover ratio or the stock residing period. Stock residing period. And similar to the debtors turnover ratio, here we calculate the creditors turnover ratio. So how do you do it? You divide the creditors by the purchases. Again, this is credit purchases. Now, this is then again the same example. Now, in order to manufacture a good, you would have gone and purchased raw materials. And these raw materials will be on credit basis. So which means you may take some time to repay this creditor with the money that the material that you have purchased. So how long do you take to repay your creditors? That is what creditors turnover ratio or creditors turnover period. So before going into the asset turnover ratio, let me explain you. On the board, so we learned something called operating cycle. So what is operating cycle? Debtors turnover period, stock turnover period, creditors turnover period. Debtors turnover period, stock turnover period, creditors turnover period. Now you know how to calculate these 3 ratios. So what you do, operating cycle means you add the debtor turnover period into the stock turnover period and divide it by the creditors turnover period. So effectively, if you say your debtor turnover period is 45 days, stock turnover period is 25 days, and creditors turnover period is 40 days, means effectively your operating cycle is 30 days. So what do you mean by that? This is the time period that you take from the point of view of purchasing raw materials up to the point of collecting money from the debtor after going to the production stage of your goods. Okay. And the last ratio that we are supposed to look at is the average turnover, asset turnover ratio, which is sales divided by average total sales. Average total sales. Okay. So these are commonly the ratios that we go through for a business concern. But most of these ratios may not be applicable when you look at a bank. From a bank's perspective, these ratios may not be applicable 100% because banks doesn't produce goods like this. Banks doesn't do the credit purchases or maybe the credit sales. So because you are selling loans and deposits. So what we do is for the banks, we calculate different types of ratios. Our liquidity ratios are slightly different because we do based on the central bank guidelines. So the ratios that are relating to a bank would be probably, we call it as non-performing ratio. Out of the loans that you have given, how much is non-performing? Or maybe you might have net interest margin. That is, you accept deposits and you pay interest. You give loans and you collect interest. So what is the difference between these two? The interest that you collect from your customer and the interest that you pay to your depositor. So that is what known as interest margin. Likewise, you have various types of ratios. I don't think that it will be tested in your examination, but just for knowledge. But these type of ratios are must. You need to know that because in the examination, you might be tested with these. And moreover, when you are evaluating a credit appraisal of one of your customers for a loan, you might have to calculate these type of ratios, okay, based on their financial statement. Because from a normal trading business concern, you have all these numbers. How much is debtors, how much is current asset, liabilities. You know how to calculate the gross profit, then net profit, and you also know what is the stock amount. So everything is very clear when it comes to a trading business. Okay, so I can just for an example, I can show you. Yes, let's look at. Okay, so let's look at this. This is the Haley's financial statement that I shared with you all. So you will see in this financial statement, this is a profit or loss. You have the revenue. Revenue is your sales. But the problem here is we don't know out of these sales, how much of sales is done on credit basis. How much of sales is done on credit basis. So that is where we have the problem. Other than that, this is what the sales amount is. Then you see the gross profit. You see. Then what is net profit? Net profit is the profit or loss for the year. Profit or loss for the year. That is this line. Okay. Now look at this. This is the tax. Amount of tax. And this is the profit before tax. Now, for somebody to calculate the EBIT, earnings before interest and tax, what do we need to do? We need to take the profit, that is profit after tax, and add the tax amount, and you add the interest paid. Now interest paid is in when it comes to this type of a company, you see here the finance cost. Finance cost means That is the amount of interest paid. That is the amount of interest paid. So every information is readily available in a financial statement. The items that might be missing is sometimes the debtors, creditors, those type of amounts. Sorry, the amount of credit sales that you might have done and the credit purchases that you might have done. Okay, but in exam questions, those will be given. Then when you go to the balance sheet, statement of financial position, you see non-current assets. Then you have the current assets. Here comes the total assets. Then you have the equity. Then you have the non-current liabilities and the current liability. So when you want to calculate the current ratio, what do? You take the current assets. Total current asset is 117 billion and current liability is only 112 billion. So when you calculate the ratio, how much will it look like? It will be like 1.2:1. 1.2:1. So which means they are not maintaining the liquidity position perfectly, because the perfect position will be 2.2:1. But here they are somewhat managing. Further, look at here. When you look at the current assets, how do you calculate the quick asset ratio? You take the current assets and you have to deduct the stocks. Now, what is the amount of stocks? You see, inventories. That is the amount of stocks. So from 117 million, you take out 42 million or the billion. That will be your quick asset ratio related component. Okay. So likewise, you can calculate any ratio based on the financial statements that are given by a company or a business concern. So we have done all the topics that we are supposed to cover. And before we wind up, I just want to give you a synopsis of the question number one. So how do we look at question number one? Okay, let me take you through with regard to the September 2019 question number one. Okay, now when you get the paper, this is the question. Question number one is, right? Okay, so this is what the question is. Normally, it generally runs up to 2 pages. So when you look at when you get the paper, when you read through, you will see question number one will be the biggest question. So it will have information relating to the question that is given and what to be done. So my advice to you in the examination, what you are supposed to do is, when you get the paper, there will be 15 minutes of reading time. So don't look at question number one, because it's pointless. Anyway, you are going to read it several times in the examination when you are doing the question. So don't waste your time in reading the question number one, as long as it is this particular question. To read that question number one and understand is no point. Better you spend that time on the other questions for you to understand and prepare yourself which questions to be answered. Okay. So question number one, what you do is, when you start doing it, maybe the last question that you will attempt in the examination, the question number one will be, first you have to go to the bottom of the question, which is this part. Now, if you look at this part, it has 4 parts for 20 marks. 4 parts for 20 marks. And you see how these marks are allocated. Part number 1, they ask you to prepare a trial balance as at 31/12/2018 after adjustments or corrections A to B above. So what do you mean by adjustments or corrections? Yes, I have already told you. Now, in this question, they have given 5 adjustments, A to E. So you have to incorporate all these 5 adjustments into your financial statement. But what they say here is they want you to prepare a trial balance after adjusting or correcting from A to D. So which means E is not relevant. E is not relevant. But what is E? E, they say transfer of 2000 rupees to statutory reserve fund. So can you remember when we did the regulations to banks, I explained what is statutory reserve fund. And here comes, they say transfer rupees 2000 to the statutory reserve fund. Okay. So what do you do? First, you are required to prepare a trial balance. Then you are required to prepare a statement of comprehensive income. Then you are required to prepare a financial position, and last, the statement of changes in equity. So the statement of comprehensive income is your P&L. Is your P&L. Statement of financial position is your balance sheet. Is your balance sheet. And statement of changes in equity is the equity statement. Equity statement. So all in all, if you look at it, you are required to prepare almost 4 statements, including the trial balance. So there is a trial balance and 3 other financial statements. 3 other financial statements. So let us look at how to do this. So what do we do here is, before we go through the trial balance, we have to look at the adjustments and do the necessary adjustments in the financial statements. Do the necessary adjustments in the financial statements. Okay. So let's look at one by one items. Following adjustments, corrections are required to be recorded when preparing financial statements of Perfect Bank PLC for the year ended 31/12/2018. So the financial year end will be 31/12/2018. And the trial balance is also given as of the same date, 31st December 2018. Adjustment number A. Financial assets recognized through profit or loss includes 200 number of shares invested in Joy Lanka Limited as at 31/12/2018. Market price per share of Joy Lanka Limited is 80 rupees. So now we have to look at what is this financial assets recognized through profit or loss. Can you remember under SLFRS 9 classification, we looked at 3 types of classification. Financial assets at amortized cost, financial assets at fair value. Now, these financial assets at fair value had different components. One is financial assets recognized as fair value through P&L, and financial assets recognized through other comprehensive income. Okay. So when you go through the trial balance, here you will see item number 4, financial assets recognized through profit or loss account. So they say the financial asset recognized through profit or loss is 18,000. But as at 31st December 2018, they say there are 200 shares and the value is 80 rupees. 80 rupees. So what do we do here is, so based on the information provided to you, you have financial assets at fair value through P&L. profit or loss. Now first we have to know that these financial assets are maintained at fair value. Maintained at fair value. So as of 1/1/2018, that is at the beginning of the financial year, they say it is 18,000. But our problem here is we have to calculate the fair value as at 31/12/2018 because our financial year is 31/12/2018. So financial asset at fair value through P&L as at 31/12/2018. So what is the value? The value here is 16,000. Why? They say 200 shares at the rate of ₹80 each. So which means these shares are listed in the stock market and they are traded at 80 rupees per share. 80 rupees per share. So every share is 80 rupees. Means for 200 shares, it will be 16,000. So now what do we have here? Fair value gain stroke loss. Fair value gain stroke loss. So originally this company, when we measure the value of the investment as at 1/1/2018, it was 18,000. Now when you measure it on 31/12/2018, it has come down to 16,000. So there is a drop in value. When the investment value drops means, is it a gain or a loss? It is a loss. Loss of how much? 2,000. You see? Now in the exam perspective, this is your working. This is your working. And you can say working A. Because you are doing the adjustment A. Now this has to be done in your answer book itself. You can't go and do it in another piece of paper or maybe in your question paper itself. No, you can't do it. It has to be done in your answer book itself. Because the examiner will be giving marks based on this working. So you have to show this working in your answer books that are provided at the time of the examination. It is very important because a lot of candidates make this mistake. They don't do it on the answer book itself. They do it somewhere else and they go and put the answer, no, which is incorrect. You have to do it in the answer book itself to derive what is the answer for this particular by doing a working pertaining to this. Okay, so we have dealt with adjustment number 1. Let's go back to the question. So we have done with the adjustment number A. Now, what you need to know is how do we go and adjust this in the financial statement? Now, in the financial statement, there will be one line which says fair value gain or loss from financial assets recognized through profit or loss. So there you will have a debit of 2,000 and the credit will go to the financial assets recognized through profit or loss, which is your assets. You see this fourth line, 18,000. Now it will become 16,000. It will become 16,000. So this is where they want you to do the adjusted trial balance. If you look at the question, they say for you to prepare an adjusted trial balance. So how do you prepare the adjusted trial balance? Is you have to go and adjust the impact of all these items into this particular trial balance. And you have to redo the trial balance. Redo the trial balance. Okay. So there will be debit coming in as fair value loss from financial assets recognized through profit or loss, and this 18,000 will become 16,000. Next item, purchase of office furniture amounting to 6,000 during the year was accounted in the miscellaneous payment account. Now this is where you have to be very clear with your double entries. When you purchase office furniture, what is the double entry? You will debit office furniture account and credit cash. Now what they have done is they say purchase of office furniture amounting to 6,000 during the year was accounted in the miscellaneous payments account. Now their mistake here is instead of going and debiting the office furniture account, they have gone and debited the miscellaneous payment account. Now why this is given? Let's go back to the trial balance. So look at the trial balance and see whether you have something to say that office furniture or fixed asset, something. Do we have anything? Yes. Here you will see property, plant and equipment, because when you say office furniture, that is your property, plant and equipment. So instead of debiting this property, plant and equipment, what they have done is they have gone and debited some miscellaneous payments account. Where is that? That is here. You will see. So debiting this 6,000 into this account is a mistake. Okay. Under accounting errors, we learn this. Posting to the wrong account. You see. So the 6,000 has been posted to the wrong account. So you have to credit this account and debit property, plant and equipment. So this will become 0 and this will go up to 26,000. Okay. So I can show you these two adjustments as of now. Now look at the trial balance they have prepared. As you know, the financial assets recognized through profit or loss has become 16,000. You see, that is there. And the miscellaneous payments account has become 0. And the property, plant and equipment account has become 26,000. Okay. And fair value loss on financial assets recognized through profit or loss, the 2,000. You see. So far the adjustment, two adjustments that we have done, it has gone to the trial balance and you have to adjust it accordingly. Then that's adjustment C. External auditor of Perfect Bank PLC recommended to make an additional impairment charge of 5,000 in respect of impairment under stage 2 for the credit card portfolio. So you know what is stage 2 is. So for that, you need to make a provision of 5,000 impairment charge. So when you make an impairment charge, what is the double entry? You have to debit the P&L for impairment expense and credit the impairment allowance or accumulated impairment. So let's look at how they have accounted for this. Here you will see already in the trial balance, you have an impairment charge of 4,000. Okay. But the accumulated impairment is deducted in this. Financial assets at amortized cost. You see, net of impairment. So what is happening now? They want you to provide another 5,000. So which means your impairment charge will have to go up by 5,000, which is 9,000. And your financial asset at amortized cost value should come down by 5,000. So this will become 155,000 and this will become 9,000. Do we have that? You see, this has gone down by 5,000. So from 160, it has come down to 155. And the impairment charge has to go up by 5,000. So that from 4,000, it has become 9,000. And the last adjustment, amortized interest expense of 2000 for the month. So for the P&L deposits, you have to adjust the interest of the your deposits by another 2000. So where do we get this? Amortized interest income. But here comes amortized interest expense. That is 12,000. So they talk about amortized interest expense of 2000. So when you amortize your interest expense, it will get debited to your P&L by 2000. So which means this will go up by 2000 to 14,000, and the credit will go to financial liabilities at amortized cost. Do you see? And this will go up by 2000. So let's see whether the trial balance is adjusted accordingly. Yes, you will see financial liabilities has gone up by 2000, and the amortized interest expense also has gone up by 2000. So basically, when you look at it, after adjusting these four entries, your trial balance would look like this. But initially, when you looked at it, your trial balance was like this. Or in other words, this is the list of account balances. So from here, how do we get into this? That is very important. So what is the first thing that you do is, after adjusting your entries, you have to mark all these list of accounts, whether it is an asset, liability, income, expense, or equity. I think you might recall in the class earlier, we did one question, how to identify the trial balance and how to mark these asset, liability, or all the items. So that approach has to be put in here. First, you have to mark whether these items are asset, liability, income, or expense, and then only you get into the aspect of putting them into the two columns of debit and credit and marking them accordingly as asset, liability, or income, or expense, or equity, after considering the adjustments also. Okay. So this gives you an adjusted trial balance for the Perfect Bank PLC. Perfect Bank PLC. So based on this trial balance only, now you have to prepare these three financial statements. By the time you have done the trial balance, you have scored 5 marks. You see? So how do I verify my trial balance is correct or not? By having or getting the two totals same, 267. That is where it is important. Okay, you have to get 267 for both. And you will see, once you have done the trial balance correctly, you can proceed with the three financial statements. So more or less, these three financial statements will be in the format that I have given you earlier. For a bank, you can take the commercial bank financial statement that I have shared you. In that template, you have to prepare the financial statement. Okay. So the statement of comprehensive will look like this. And the equity will be like this. So what you need to remember is, when you are doing the statement of financial position, you know it has to be in the order of decreasing liquidity. Decreasing liquidity. Always remember that, because you are doing it for a bank. So when you are doing it for a bank, it has to be in the form of order of reducing liquidity. And this template is almost in line with what I have shared with you previously for commercial bank, when I gave you the two sets of financial statements for Alis PLC and commercial bank. Okay. So before you go to the exam, you can attempt maybe say the last 3 papers, because that will give you some idea. But prior to that, what happens is it will be under the previous accounting standards, LKS 32 and 39. So I would not advise you all to go through that in this for this exam, because basically subsequent to the first standard SLFRS 9 came in, the 3 examinations would be the last 3 examinations, which is September 19, March 19, and probably the September 2018. Okay, so prior to that, you can give it a try, but the only thing is it will have the different classifications which might confuse you. So better you go by this latest 3 papers, which will be sufficient enough for you to look at. Okay, so that is all about question number 1. So we will stop there, and I hope we have been going through these lessons, and we have come up to the end of this course module. So if you have any questions, you can always write to me. I think I have given you the email address, or if you can, if you want, really, you can approach the IBSL and get them to give you the contact number. They have my numbers, so you can talk to them. And if there are any clarifications or questions that you may have, you can always post to me before the exam, or you can call me, so that I am happy to answer, because this session that we have been carrying out was online. So sometimes it might have been difficult for you all to grab certain things, or maybe it prevented you from asking certain questions. So I would urge you, if you have any questions, or if you want to clarify something, please do post or call me, so that I am happy to answer any questions. Okay, so I am wishing you all the best for the examinations, and do your best in the examination.